everybody. Kirk Spano here, Macro Dashes, Global Trends ETF, and other stuff. Give you the heads up here. I'll be doing more podcasts with Wall Street Breakfast over at Seeking Alpha. I am recording one tomorrow morning, and it looks like I'll be interviewing some of the other investment writers on the site and doing some other things with Seeking Alpha as they ramp up their podcasts. So maybe I can become the next David Rubenstein. Or maybe Joe Rogan, except smart. All right. So if you're not reading Wall Street Breakfast, this is one of the two things that I get emailed to me from Seeking Alpha. The other one is the must reads. If you go through these, they're pretty good. I actually like keep you up to date, along with the 5 things to know from Bloomberg. Pretty good combination of quick reads in the morning. Wall Street Journal has something similar. Let's see where we at. Well, we are at earnings in the second quarter. So I definitely want you to read this article. I will have it up on Fundamental Trends as I just finished it a few minutes ago after the webinar. And we're going to go through this real quick. I want you to keep an eye on some things, and we're going to use some graphics here that we know about the last quarter, and then as we look at this quarter. So energy was the big grower last quarter. And the GAAP versus non-GAAP differential last quarter was not so good. Guidance was down by 67% of the companies in the S&P 500, which is typically right around 58, 59% for the 5-year average. So what that means is that they talk down the expectations so that they can get over them. And it's very rare that they lower expectations. So we're in the part of the cycle now where they are lowering expectations. And I think that this quarter is probably going to be worse than people think. And then the next quarter, we should start to see the comparables and the year-end expectations coming in that will indicate a bottom in the earnings cycle sometime this year. I'd say probably by Q4, and that earnings will start going up again next year. And I expect that because I think there will be a couple of things that happen between now and next year. One of them, and we have talked about this before, is that I think that there will be an announcement of an agreement between several oil companies and the government to refill the Strategic Petroleum Reserve with excess produced oil, meaning that the oil companies have been very careful about their spending because they don't want to see them go back to the problems that they had 4, 5, 6, 7 years ago. They're all cash flow positive again, and at least the survivors are, and they want to stay that way. So for them to produce more oil, they have to know they're going to get a certain price from the government. So I think they'll come up with some sort of scale to pay between $60 and $70 a barrel for new oil that's produced. So oil above what they produced in the last year. So that means that a company can't just pivot from selling from the private market to the government with oil that they had already been producing. They're going to have to produce more oil in order to fill the SPR. And I think that agreement, I know that they're talking about it. So I think that agreement comes probably this year, but for sure by next year. And that'll be all that we need to see oil chop along for years. I don't think you'd see a big spike unless there's a war, and I don't think you'd see a big crash because the government is going to support the market, which means that the companies that have oil that they can produce economically are going to be pretty good companies to be invested in. And I hate that, but it is what it is. So one of the things that jumped out at me about earnings last quarter is that 8 of the 11 sectors were showing that half the companies had a net decrease in profit margin. Part of that was due to energy inflation. Part of it was due to wage inflation and services, but also the supply chain still being mucked up a bit. The supply chains we can see are getting better and better and better quarter after quarter. That should continue with speed bumps. So from time to time, there's going to be a logjam, and I don't think that you can avoid that until the semiconductor and automotive supply chains are completely built out in the United States Still about 3 years to go on that. And then all the associated industries catch up. Materials, I know that people think that there's going to be a materials and commodity super cycle, but with the exception of copper in the short run, probably through the end of the decade actually, so that would be intermediate term, and just a few other things, there's not really a shortage of anything other than what climate change is causing with food, what war is causing with food, and the materials that we need to transition in energy. So lithium is something to keep an eye on, so is silicon, and we have to be aware of where these things come from, how long they take to ramp up on production. With lithium and rare earth metals, it's not so much finding the raw materials, but it's processing them. So it probably takes the full 3 years for a lot of these things to catch up. Some of them will get there sooner. Probably building the factories happens first, and then getting all the materials and the resources is going to be a work in process, probably from now until near the end of the decade. Does that mean that certain materials are going to be super expensive? No, because a lot of the spikes in price have already occurred, probably with the exception of copper, I think. And the hype cycles are probably getting close to turning over. So if you think of things in terms of the hype cycle, 3, 4, 5, 6 years ago, everybody was talking about lithium. Lithium went from super cheap to now it's expensive. It's probably almost as expensive as it's going to get. Could it go up a little higher? Sure. But then it's going to turn over as more lithium production and processing comes onto the market, which we know is occurring. It's just that it takes several years. So this energy transition is a big deal, and it affects almost everything. And we just have to keep working our minds to wrap around what is going on. And one of the industries that I'm very excited about is actually automotive, because the pent-up demand for cars is huge. The average age of a car now is the oldest that it's ever been. People, and you know that I've been doing this, people are waiting until they can get an EV at a fair price. And I think everybody knows that the next generation of batteries, at least people who want to know and are willing to know, the next generation of batteries on the cars and the motors are going to dramatically cut prices, extend range, make the cars more affordable. So you've already seen Tesla cut prices, and I think you're going to see them come down to the luxury level pack and be similar and cheaper than they've been, and be similar in price to your Volvos and your BMWs and some of your other higher end cars. I actually don't believe that Tesla ever has a $25,000 car. I think that from a business decision standpoint, that's the wrong decision for them. I think they should have their cheapest car in the 30s and then higher. So if you think of it in the BMW model, they would have a 3 Series, which is actually, in fact, their Model 3. So I think that the Model 3 and the Model Y will be their $30-something thousand cars. Do they put together a tinier car for other markets other than the United States? It looks like they're going to. But I think that's really just going to be the Model 3 modified. So those will be the entry-level cars. They're not going to really go smaller because nobody wants smaller. Even in the foreign countries, they don't. So you can take what Ford is doing in Europe with the Explorer. The European Explorer is basically going to be the same size as the current American Escape. And you just change the size of the cars to the market. In the United States, I don't think we see any of these tinier cars. They don't sell now. I don't think they'll sell later. I think Tesla and Ford have already figured this out. I think GM will catch them. But the pent-up demand, as the price of EVs comes down, is huge. These companies could do really, really well from 2026 sometime into the 2030s. And then by then, cars are cheaper, they've been replaced, then sales slow down. So the car companies to really be involved with are the ones that have fourth industrial revolution technology that they can adapt to other industries. And if they happen to have freed up real estate, that's even better. We know of such a company. So as you go through these earnings and you start thinking about the business models and what things are going to look like 3, 4, 5 years out, you can answer a lot of questions. What do we know about earnings coming up? Well, according to FactSet, we should expect earnings per share to fall about 6.3% this quarter. So we now have a full year of earnings having fallen, and I think we probably get another bar like this in the next quarter, but then it starts to shrink up and then go back positive. Will we get a bar like this? No, that was the COVID closing, but we could get a bar like this and a couple like this. So think of the way this worked, but in reverse. The big disparity is between earnings and the S&P 500, which had a bit of a correction, but it doesn't really match the decline in earnings. This rally that we've had this year is on hopium that the Fed is going to lower interest rates. I categorically reject that. I don't see any interest rate decreases this year. What I think is the most likely scenario is that we are in the great normalization and that rates will only come down a couple points in the future, not soon, and that quantitative tightening, because of the havoc it's wreaking around the world, is probably what they cut first, and that would be fine. So if we completely get rid of QT, say a year from now, that would be quite a stimulus, because now you don't have money being sucked out of the system. In addition, you have all the bank bailouts, and they're really depositor bailouts because they're letting the banks go to zero, which is what you all asked for after the Great Recession. Let the banks go to zero, just take care of us. That's kind of like quantitative easing. How so? Well, we just saw $30 billion or whatever it was get pumped into the banking system. It's there so that these banks' balance sheets don't blow up. What happens as interest rates start to drift down? Suddenly, the bank portfolios of assets of bonds go from losses on a mark-to-market basis to even to slightly profitable. So that's all money that can flow back into the system. I think it takes a year or two for this process to play out. Certainly would make sense for it to start before the presidential election, and that becomes a de facto stimulus. So by getting rid of quantitative tightening or cutting it down, so that the dilution that I talked about last week in my article for the banks, which is going to be met with money to support depositors, becomes stimulus a year or two from now. I'd say probably about a year from now. That's why I think that we are close to the end of the bear market, because earnings are bottoming out over the next quarter or two or three, certainly by the end of the year. And then we go from a tightening financial situation to a financial situation that is loosening again. But don't look at it through the lens of the Fed lowering interest rates. When you consider what the federal debt is, what you want is have real interest rates at about zero. So if inflation is 3% on a long-term basis, that means that the Fed funds rate can be about 3%, and that the 10 and 20-year treasuries can be a little bit above that. On net, the government is trying to pay zero in interest. I don't know that they can quite do that, but consider this. Looks like there's an agreement on the debt ceiling that will include that they have to spend the next year negotiating on moving the budget towards being closer to balance. What have I been telling you for 3 years, 4 years, actually, I think before COVID? What's going to happen to the U.S. budget in the 2030s? It's going to be very close to balance, and they might even run a surplus. What happened under President Clinton is going to happen again in the 2030s, and it's demographically driven. As boomers start to die, and the millennials are still in their peak earning years, and the emerging markets are growing, and energy prices are coming down, and real estate gets transitioned so that commercial becomes residential, and that lowers rents, you could see the United States become a gigantic Switzerland. What do I mean by that? We'll just be the fortress. We will be the new bank of the world, which is why the talk about dollar collapses and de-dollarization are wrong. Certainly there will be hedges against the dollar that gets too strong or too weak, but the main problem for the world isn't that the dollar gets too weak, but that it gets too strong. We just saw that again. And so while the popular narratives don't agree with me, I've been right for better part of 2 decades and they've been wrong. They're having a little moment in the sun right now, but only because we're coming off of a peak high spot in the dollar. How does that play into earnings? Well, it's just part of the cycle. So if we get another pop in the dollar here over the summer, which I think if they announce an oil deal with the majors to refill the SPR, and the president indicates that he's willing to do a little horse trading on the budget over the next year, you're going to see the dollar stay firm. And that millennial dollar, which is what I'm calling it, that millennial dollar, it just chops around 1 relative to the basket versus 1.1 or 90 cents. That's probably the range, but you shouldn't expect to go much above it, and you shouldn't expect to go much below it. We are in a new higher trading range for the dollar. It's permanent for all intents and purposes, excluding spikes and crashes due to, aliens and whatever happens. And in that era where the dollar is stronger, in India, if you've been watching the rupee, in India over the next couple generations slowly catches up. And maybe in the next generation, they hit the inflection point on growth to take the place of China for what China did the last 2 generations. And they're not close. They're years and years away from hitting that inflection point where their economy starts to really catch up to the United States, China. China's economy is 4.5 times bigger than India's economy. They have about the same amount of people. So you can see where there's a huge gap to be closed, but it's not a straight line. It's a curve, and it hasn't hit the inflection points of going up faster yet, but it's coming, and cheaper energy will be a part of that. So as India moves towards energy independence, they probably won't get there for a long time, but as they move in that direction, and as they provide more services, which they have been, they're building a website for me now, you're going to see a lot of growth in the world from the emerging markets and from the United States, and it's basically imminent next couple of years where it starts. And the strongest growth will be probably late this decade or early next decade and then through the next decade. You need to prepare for that as an investor now if you truly have an expectation that you're going to be here in the 2030s. Now, valuations came down on the bear market, but we're still at the second standard deviation. I don't know that I expect that we would see this without an event or aliens, whatever, but I do think that we'll see us get to kind of this level. See that the market gets to this level pretty frequently. I think it's going to happen again. We'll get to this level again. That is indicative of a 10 to 30% drop in the S&P 500 from here. So we should expect a 10 to 30% drop in the S&P 500 from current prices. That means middle 3,000s to upper 2,000s. Could we get Armageddon zombie apocalypse down here? We could. We've been known to really screw up once in a while or have bad luck. But even with COVID, look at this. You can think about that. COVID only made it get to here. Granted, they printed gobs and gobs of money, way more than they needed to fill the economic hole that was created. We are going to benefit from all that capital being in the system because there is no shortage of capital to do things. Money markets, primarily filled by the family offices, right? The wealthy are at all-time highs. Guys like me are sitting on 6 figures. Private equity firms are sitting on millions and millions and billions. From the small private equity firms that are run by 3 family offices that have 100 million, all the way up to KKR and Blackstone, who have billions and billions. If you can bring yourself to think about what's going on as multiple transitions, demographics, technology, energy, the way that we work, climate change, if you can think about all these things moving together, you start to see how they function. Here's the Buffett indicator. Valuations came down, but they're not low by any stretch. Hope this pops out. There you go. This is from Barini and Associates. A year ago, the PE ratios were here, and they've dropped to here. So the S&P 500 is within a little bit of normal, but remember, earnings still have to come down. So while the PE ratio may stay at 18, if earnings go down, prices also go down. So there's not a lot of contraction left in PE ratios. We just have to find the bottom in earnings, which I think is between this quarter and the fourth quarter. And the market probably anticipates that. But when the market realizes that interest rates probably aren't going to get cut because absent of an event, probably not going to have the Armageddon zombie apocalypse, the market will turn up. And as QT gets cut, which could be very well strategic to the election, as announcements on refilling the strategic petroleum reserve happen, those will be positive. So as those narratives cross in the wind, you'll get your volatility in the market. And what you want to do is avoid FOMO, chasing bad assets just because they're going up, and focus on these transitions and where the big money is going to be over the next 3, 4, 5, 10 years. And we know that it's in the clean energy transition. We know that certain fossil fuel companies still have a path to profitability. We know that the federal government probably supports that path because they always have. But they are phasing out the frackers. They're going to use up the frackers over the next several years. In most of the basins, you're not going to see any production increases ever again. Permian is the only one. And even that probably runs out by 2030. But the Bakken, Stack Scoop, pick any of them, especially the Rockies. You're not seeing more production from those basins because they already got the easiest oil. The new oil is more expensive. The communities aren't supporting more development, except maybe in North Dakota. Even Oklahoma is pushing back because they can't figure out how to not have earthquakes when they get rid of the waste. So that leaves the Permian. And the Permian, with its proximity to the Gulf Coast and its pipeline networks that are getting connected nationally, Kinder Morgan, one of our favorites, is in on that, is probably where the best oil and gas companies are. There's certainly some gas up in the Marcellus and Utica still. And those are pretty good growth paths for the next decade or so, mainly because as the rest of the world gets rid of coal, those plants can be converted to natural gas. And since Russia is really only sending gas to its allies now, mainly China, that means that Europe and the rest of the world, to get them off of coal, we have to sell them gas, New Fortress Energy. So you got to be very selective in which companies you pick out in the fossil fuel realm. But we just saw on Bloomberg this morning a discussion about natural gas. It was very clear. Natural gas is coming from OPEC, mainly Qatar, and the United States. Who do you know is producing natural gas in unique ways? Clearly the fast system from New Fortress Energy, where they can load LNG right on the water. Little company in California with renewable natural gas that's storing underground right now. There are places to invest in fossil fuels if you're willing, but you better understand that it's not just about sticking a straw in the ground anymore. They have to have a good plan for the future of energy. What I really like are the clean energy companies and scaling into them. Here's a chart of my 3 favorites. First Trust Clean Edge Green Energy Index Fund. It's a long name. They should just call it the First Trust Green Energy Fund. I think that's what I wrote it as. Then the Invesco Wilder Hill Clean Energy. Invesco Wilder Hill Clean Energy. First Trust is more large cap and market cap weighted, so the biggest companies have an outsized impact. And then you have Invesco's Clean Energy Fund, which is mid cap mainly, and it's level. So all the holdings are between 0.5% and 2.5%. There's no 8 or 9 or 10% holdings like in QClean, which is heavy in Tesla, and Albemarle, which is the lithium producer, biggest in the world, maybe second. So interestingly, those 2 clean energy funds get you a pretty wide range of holdings, and I'll break those out in an article soon. I'm also trading the solar index. I haven't in a while, but it's something I'm keeping an eye on. Very minimalistic trading. However, if I can get one more dip here, I can probably buy it and hold it for a number of years. So not week to week trading, but let it have a dip, zig, 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 and then buy it. And then hold it until it gets up here. Then we have to decide if it's going to break out or if it's going to come back down. And probably we do a couple of things. Probably keep some, probably sell some covered calls. Take a look at the S&P 500 over the last 5 years since 2019. So about 4.5 years here. And notice what's going on. The S&P 500 can't beat any of these indexes on clean energy. And even PBW, which is super heavy in small caps that have got annihilated, beat the S&P 500. Now, if I shorten this up to, I believe, the end of 2021, the S&P 500 beats them all, I think. I could look. In fact, let's look. Let's just go back a year. Does the S&P 500 beat them? Almost. Still doesn't beat solar. But what's going to happen is that as the S&P 500 comes down and as these bottom out, which is what they've been doing, you'll see these ramp up again. And they will, again, vastly outperform the S&P 500. And I think that this small cap one, the small and mid cap one, PBW, stands a very good chance of doing as well as the solar, which gets a lot of the rah-rah and, hype cycle stuff for at least a few years. And then at the end of the cycle, the large caps will outperform. Now, if you've been watching Tesla, you know that they've been getting their teeth kicked in, which a year and a half ago, I did that video where I said Elon Musk would lose half of his wealth. Who else a year and a half ago was saying Elon Musk was going to lose half of his wealth? Zero. Nobody. I dare you to try to find somebody else who a year and a half ago said Elon Musk would be worth half as much at some point in the next few years. Well, that's probably bottoming. So Tesla is pretty attractive to me right now. I don't know if I quite want to get in there yet, but as the stock market bottoms out, Tesla is going to be one of the ones you want to own. They're going to benefit from the pent-up demand and the fact that they're producing in China and they're going to be producing in India. Maybe they never get the German factory off the ground. Who cares? Europe is slow growth in a slow growth forever world. They're the slowest growth. So Tesla's going to build in Mexico, which I think is brilliant. For all the weirdness of Elon Musk and all the ethical questionability, is that the nicest way I could have said that? The dude makes money. What he's going to turn Twitter into, if he doesn't break it completely, which is something he's going to, basically take the place of WeChat, right? We don't want to do business with Chinese technology, so we're just going to replace it. What if Twitter, which is now going to be called X, the X app or whatever he wants to call it, brings back the thing that they had that turned into TikTok, right? I don't even know what it's called anymore. But Twitter had something that was just like TikTok before TikTok, and they got rid of it because last management sucked. Brings payment systems into it, requires that everybody pay a little bit of money to be part of it so that you're verified, which is what I said that Facebook should have did years ago. Charge $1 for life. What would have happened though is there would have been a black market selling IDs, selling profiles. So you would have had to limit people to how many profiles they could have in their life. In any case, this is the direction of things. The company that I really want to focus on at the top end of the tech companies, remember 7 companies make up half of the NASDAQ index, like 35% of the S&P 500, Google, Microsoft, Apple, Amazon, NVIDIA, Tesla, and Meta. Those 7 companies. You just follow that basket of 7, pretty much know what the market's going to do, which is why I told you a couple of weeks ago, just pay attention to Apple. If Apple takes a digger, the whole market takes a digger. That can create a little bit of panic. Then you get your market bottom. And again, whether that's 3,600 or 2,800 on the S&P, hard to know. A lot depends on things that are unknown. You have your known unknowns, things that you're watching. Then you have your unknown unknowns, things that you're not watching that just might happen anyway. Your black swans. We still know the potential culprits there, but I'm sure there's others that are so far off our radar that if they happen, there you go. Does anybody else think it's weird that the Pentagon's been talking about aliens last several years? Makes you think they're getting us ready for something, huh? Anyway, Amazon, the thing I really like about them is that they have the infrastructure in place, and now they're tinkering with employment levels to support expanding into a lot of other industries. So back at CES 2020, I told you they're on the glide path to getting into even more industries and providing services, which you haven't really done except at the very professional high-end level. Weirdly, I think that if Amazon splits into 2, a retail side and a technology side, that the value of both companies could end up being more within a few years than the current company. So I think Amazon is a pretty easy double or triple from this point. So we should be scaling into that one and looking for the dips. It just had a rally. Yeah, let us get some of that back and then buy it. It might have set a low already. So if we get about halfway back to the low, right, the rally from the bottom to now, you usually retrace around half of that. You have your fib levels, so maybe it retraces 30-something% or 60-something%, but around half. So I'll show you some charts on Amazon and what I'm looking for there. And between me and Shooter, we'll try to find some places to buy that. Amazon, I think, has an awful lot of upside as they get into more businesses during the 4th Industrial Revolution. I be remiss not to mention Apple. I think that it is inevitable that Apple buys a media company, whether it's Paramount or Warner Brothers even. But I don't think it's going to be Warner Brothers. I think Paramount makes the most sense based on its size. I think Disney would be too much to chew on. But Paramount, with their deal with Walmart, if Apple bought that, man, Apple could very quickly increase the amount of money they charge for their streaming service, make it $199 a year. That is the top half of the income strata for the most part around the world. All those people would pay for it, especially in the Western world. Maybe you have to have a lower price point in emerging markets and some other places. When Apple makes that deal, the company they acquire, the share price will go up. Apple's share price will come down. And that's when you want to buy Apple. All right. So this was the earnings piece. I still have 5 more pieces coming. I'll get them all out this month. Then for 2 weeks in California, you can come and visit me if you want to come to San Francisco. I am changing my hotel in San Francisco. I'm going to do that this afternoon. I didn't realize the hotel I was at, which is downtown San Francisco, is right next door, across the street actually, from the Whole Foods that just shut down because it's so dangerous there. So we're going to go stay closer to the water. I will be there May 2nd to the 7th. I'm going to put up an article with just what my travel schedule is. And if you want to meet me for breakfast in particular, that is definitely welcome. And I already have a lunch appointment and then a day down with Ametis and my semiconductor buddy. So there will be some times to meet. If anybody wants to go to the Brewers and Giants game or just meet me before that, we will be over by Oracle Park on that Saturday to see the Brewers and Giants. So that, depending on where you are, I know there's got to be 20 or 30 of you at least that are in that general area. So feel free to track me down. I will try to make it easy for you. All right, everybody, have a wonderful day. Read the article. I think you'll like the pretty pictures and more to come.